All right, good morning, Bob Tassone.
Good morning, John.
It's Wednesday, January 24th, 2024, 1/24/2024. And we have a wonderful topic to discuss today. I appreciate your bringing it up as a discussion point today. We're going to talk a little bit about one of your specialties with Port Financial and Port Insurance, and that would be life insurance.
Life insurance. Life
Yeah,
insurance
so
happens. Life happens.
and the point of our conversations is here today. We're talking real estate and protecting your assets, and the point of our conversations is to help people be informed, make smart decisions, and avoid costly mistakes. So, with no further ado, you sent me over a nice little summary of some of the basics of life insurance and what it can be used for, and I'm gonna go ahead and share that screen.
Oh boy.
And, and I mean, it's just a summary. I realize that, but
Yeah.
we'll have you talk through some of your talking points and let you go through that a little bit. And I don't know if
I
you
don't
can,
know how long it'll take to go through this, but I mean,
we can discuss it as we go.
this is just very basic stuff. But anyway, so the first thing is nobody really should have life insurance unless they need it. And why do people need it? Well, most of the time, the need for life insurance falls into three categories, and those categories are to pay for something or to pay off something. So you think of paying off a mortgage or paying off a loan of some type, a debt, or paying for a college education or something like that. Not necessarily a debt, but something that money is needed to pay for it.
Okay.
Or it could be for estate needs. And I have like estate equalization. I'll give you an example of that. Then there's estate taxes, income taxes, and charitable giving. So estate equalization. Let's say that there's three children and um, dad owns a hardware store, or mom and dad own a hardware store. Something happens to them, and they leave the hardware store to the three children, but only two of the children really are interested in running the hardware store. And so they want to keep the hardware store going, but they want to own it outright. They don't want to be in business with this third sibling that's not interested in a hardware store. So a life insurance policy can be set up where it provides cash to that sibling rather than the asset that is the hardware store. That's called using life insurance for estate equalization.
I like it. Okay.
Okay. And so that usually applies in a circumstance where there's a house or a farm or a business where there are children that are interested in keeping that house as a family home or keeping that farm as a family farm or keeping that business as a family business. But not everybody is interested in doing that.
Right.
And so life insurance can be used to create an equal estate for the children that are not interested in keeping the family business, the family farm, the family home. That's one reason to have life insurance. It's an estate planning tool that can be used. A life insurance policy can be used. And a life insurance policy is just a tool. It's an instrument. It's something that you use to do certain things.
Okay.
And so the other two needs that are on there, the cash needs, I think that's pretty self-explanatory. You need money for something, but the second one, income needs. And so when a person dies, if they have children, there's something called Social Security, and that will provide income for the children as long as they are children, are under age 18, basically. But that is a fixed amount that you can go to the Social Security Administration and you could see what that would be. if something was to happen to you, but generally mom or dad, they are income producing machines and the children are income spending machines. And when the income producing machine checks out, the income spending machines go on.
Right. Life goes on, and there's nothing more in life that's guaranteed than the finality of it, right?
And so there's basically two ways to generate income. You can work for it, which is what most people do, or you can have an amount of capital that produces income. And life insurance proceeds are capital. That's what they are. And so they produce income, and they can produce it for a period of years or they can produce it forever, depending on how it's set up.
Right. And I don't know, we'll get a chance to get into it, but there are certainly tax benefits to the way insurance does that, that are part of that estate planning element.
Well, the life insurance proceed is a tax-free benefit. So whatever amount it is that is created, whether it's a couple of 100,000, 500,000, a million, more, less, that is a tax-free benefit. Now, once that capital is placed somewhere in a bank account, in investments, in whatever instrument it's directed into, then there's separate tax consequences from that, because just like any asset that you have that produces income, there's going to be taxes involved in it.
But that's outside of the insurance
That's after the death benefit has been
payout, the
paid.
benefit. Gotcha. Okay. All right. All
Now,
right.
now in this environment that we're in, and everybody is paying attention to interest rates, and of course, in your business, interest rates are like everything. Well, interest rates really matter in this event as well. Over the past several years, when interest rates have been very low, if there's a cash benefit that's provided by a life insurance policy and it goes into something very safe, it was producing almost no income
Yeah.
because interest rates were at rock bottom.
Right.
And so it took a lot of life insurance to create that income, because interest rates were 1, 2, 3% at, at most. Today, interest rates are a little better than they were, but still, even at 6 or 7%, $1 million of life insurance, $1 million benefit, will produce 60 or $70,000 a year in income at 6 or 7%. So if the income making machine is earning more than that, then it's very easy to justify a need for life insurance that would be more than $1 million.
Right.
So anyway, so we covered cash needs, we covered income needs, we covered estate needs. I don't know, as far as estate planning needs, right now, under the current law, estate taxes, federal estate taxes are not an issue. But that is something that is being proposed to come back. And so it used to be that there was an exemption of $600,000. And then after that, estate taxes started at around 35 or 40%.
Mm.
And so the need for life insurance to pay estate taxes was very significant. Now that's not there, but if it was to come back, that could be a need for life insurance. Or sometimes if someone inherits an IRA or some other type of account like that, there are income taxes that need to be paid.
Right. 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 Okay.
So the last one, charitable giving. So let's say you have your favorite charity, and a lot of the charities will suggest purchasing a life insurance and setting it up in a trust for the charity. And how you do that is another discussion. It can be done where you pay into the into the policy or into the trust every year, or it can be done with a lump sum payment. But either way, it's designed to provide that capital to the charity at the time of your death. And so you can pick your favorite charity, and you can tell them, I'm setting aside $5,000 a year into this policy, and when I die, it'll be a $250,000 benefit to the charity. The nice thing about life insurance is, if you were to set it up $5,000 a year and you died early in the first few years, then it didn't take a lot of your capital to create a larger gift to the charity.
Right, right. I like it. Which let's jump ahead here a little bit and let's talk about maybe the types of insurance. So that we can kind of clarify the difference between term and whole life. You want to jumping into that a little bit?
Sure. Okay, so if we go to the types of life insurance, the most common type of life insurance that you see nowadays is what you're highlighting. That's term insurance. And term is kind of like, you're used to a 15-year or a 30-year mortgage. You can have a 15-year or a 30-year level term policy. Or you can have one that's just for 1 year, or one that's for 10 years or 20 years. The 20-year term, I think, is the most common level term policy. And that means that you have a level premium and a level death benefit guaranteed for 20 years. Now, a single year policy, which is called an annual renewable term, those are not as common as they used to be. That's the way a lot of policies were set up years ago when term insurance was around. But because of the popularity of a level term, like a 20-year term, that's the way most of them are set up nowadays, where you have a level premium payment and a level death benefit over that term.
Okay.
The end of the term, either the policy ends or the premium goes up so much that it, in essence, ends anyway, because the premium is just an astronomical amount at the end of the term.
I was just going to ask you that question. I appreciate you pointing that out. That's good. All right. All right.
I have one now there where someone's paying $200 a month for their term policy. In a few years, the end of the term comes and it goes up to like $7,000 or $8,000 a month.
Oh, wow. Okay.
Okay, from 200.
Yeah, and that has to do with the likelihood of the event, I'm sure, right? So I mean, we're
Well,
talking.
so we can talk about underwriting. I mean, John, if we're talking about you, you're a fairly young guy.
52 years old, Bob. So, I
So
got.
the chance of you dying in the next 20 years is not great, but the chance of you dying in next 30 years is greater, or longer than that.
The
And so that's
probability
why
starts to increase with every passing day.
a 30-year term is going to be a lot more expensive for you than a 20-year term. And a 10-year term could be really inexpensive, because the underwriters can look at you and say, well, we really feel like the odds are he's going to be here for the next 10 years
Yep.
or 20 years. And nobody knows their date of death. But insurance companies use the laws of large numbers. They look at people like you and the experience from people like you.
Right.
And that's how they underwrite a policy.
Well, we're right on. Okay, so and I actually predated myself. I'm not quite 52 yet, but it'll be about six or eight more weeks, and we'll be there. Next up, whole life, right? So now let's talk a little bit about whole
Okay,
life.
so we'll talk about whole life, but let's go back to term for just a minute, because I can use that to illustrate. So let's say, with an annual renewable term where the rate increases each year, you're paying the pure mortality cost every year, theoretically. Versus a 20-year term policy, the cost is averaged over a 20-year period, that mortality cost. And so theoretically, in the early years of that policy, you're paying more than the mortality cost.
Gotcha. Right. There's a
Okay.
intersection curve there of the
Yeah.
probabilities and
And then the latter years of the policy, you might be paying less than the average mortality cost over a 20-year period. Well, when you talk about your whole life and your life expectancy is 85 or 90 or whatever it is, then that mortality cost has to be averaged over that period, from the period of today through the end of your life.
okay.
Now, a lot of people will say, well, men only live on an average to age 75 or 78 or something. Yeah, that's true, but that's your mortality at birth. That's the average mortality at birth. See,
Yeah.
you and I have already beat a lot of the odds because we are here today.
Yeah.
So our average mortality is longer than that because we didn't die in a car accident at 25. We didn't die of cancer at 50 or whatever. Some people have already, as you know, I mean, we've lost friends over the
Yes.
years. And so anyway, so that's why when we talk about life insurance, we're talking about your mortality from here to, based on your health and based on your activities and your lifestyle and so forth. They come up with what they think is your life expectancy, which is already more than the average life expectancy because you've beaten a lot of the odds just by sitting here today.
There's been a few
Okay.
odds I've beaten there.
Even though with some of the things you do, John, you could be tempting
Probably
mortality.
true. That's you're probably right about that. So
But anyway,
my
um,
mother's glad I'm here. So
so we talk about whole life insurance. We're averaging mortality over your entire life. Well, because so much is being taken in the early years as like a prepayment so that the premium is level over your entire life, there's an equity, a cash value that builds up in the whole life policy.
yeah, like an annuity. Okay.
Okay.
Uh, and of course now life insurance is a business in itself. We're not gonna I don't want to get into that subject matter, but there's a business here that creates a financial system within itself. So that's potentially a topic for another day. Um,
Yeah.
so now how do we compare that to, if we want to get into, if we can jump into the whole life policy?
Well, just to say with whole life policies, some some whole life policies are more what I call cash value intensive. They're
Mhm.
designed to build cash value. Other policies are more insurance intensive. I don't I don't generally recommend life insurance as an investment myself. But that doesn't mean that there's no reason to have a whole life policy or a cash value type policy. I mean, you have to go back to the top of the page where we were talking about needs.
Yeah,
If
what
you,
are your needs and what
if you want something to cover you for your entire life, then a whole life policy is the best way to do it. If your need for life insurance is temporary because you're more concerned about covering things while your children are around or whatever, then something like that, then a term policy is probably the best idea for you. It's not really a question of is one better than the other. It's more a question of the need that you have for the insurance.
right?
Now, life insurance companies are masters at marketing. And so they come up with all kinds of bells and whistles and things, some of which I think are useful and others that I don't think are that great. But anyway, I mean, there's all kinds of things out there. And I mean, life insurance salesmen are the best salesmen in the world, or salespeople in the world. I shouldn't say it's because there's plenty of women that are excellent salespeople. But anyway, just suffice it to say that a cash value type policy can have living benefits. One of the more popular living benefits that these policies have is a long-term care rider benefit. And the
Okay.
policy is really, it's built on a life insurance chassis that you could say, but it's purchased because of the long-term care benefits.
Right. We have a lot more, we have a growing need for that kind of planning, really, as we age and age longer and live longer. Our parents have needs for care, and will have need for that care. And
Yeah.
so I grabbed a book off my shelf here, Bob, which is, I
Oh,
don't know
yeah.
if you've ever heard of this. It's called What Would the Rockefellers Do?
Yeah. Okay.
And a great book. It's a great read. And Garrett Gunderson is I think who wrote this book, but it's basically discusses whole life insurance and some of the ways in which it can be used to create generational wealth.
Yeah.
And it's fascinating subject matter. I'd love to talk a little bit more about that as we kind of talk about this
Well, we
subject.
could, like I said, there's a lot of facets to life insurance, and the conversation could go on for a long time. This is just the basics of it.
Yep. Yep. And
But
this,
generally, the other thing that you mentioned, annuity, if you fund a life insurance policy where it's too cash intensive, it becomes essentially an annuity. And so let's talk about what's the difference between a life insurance and an annuity. Let's get back to basics. So a life insurance policy, you take a small amount, your premium, your monthly premium, and when you die, it creates a large amount. And in theory, an annuity is just the opposite. You take a large amount of money, put it in the annuity, and then it pays out an income over time. That's the most basic kind of annuity. And that's what you think of like with your federal or state retirement. And sometimes it's called an annuity because you retire from Commonwealth of Virginia and you have a retirement annuity, and it pays an income for the rest of your life whether you die young or whether you die older.
right. You pay into it and then it pays you back
Right.
as it's grown from that beginning state. Right.
Well, so what people do sometimes is they put money into annuities. They put money into life insurance policies. If they fund that life insurance policy where it's too cash intensive, it becomes something called a modified endowment contract, which is essentially taxed the same as an annuity.
I gotcha. Okay.
Okay.
Well, being as
Uh,
we're jumping into 11 o'clock hour now, and I love the subject matter, and I don't want to cut you off, but actually try to keep these calls 10 or 15 minutes or so, and this is a big subject that we could probably talk about for hours, and we'll come back to that and look forward to having some additional calls on that subject. Bob, thank you so much for your time. Your contact information I'll make sure that gets into the contact page. And for anybody that's looking to contact you, Port Financial Insurance, Bob Tassone. I'm John Polson with the Memory Group, eXp Realty, right here in Williamsburg. Bob, your office is here in Williamsburg as well, right? Where is your office actually? If
Williamsburg Office Park, Jamestown Road,
Okay, right on. Okay, so
behind the carrot tree.
you
Yep.
know, we get some walk-in traffic because we're right there in downtown Colonial Williamsburg on Prince George Street. It's great to have walk-in traffic, but easiest way to reach you. What is the easiest way for people to reach out and connect with you?
Give me a call, 757-870-3521.
All right. Well, Bob, again, thank you for your time today. This is an awesome subject, actually. I can see us talking about this a little bit more. And there's so many insurance subject matters that we can chat about. I'm going to give you some more follow-up information as I learn a little bit more about this house that was damaged so significantly by this.
Oh yeah, I want to hear about that.
Okay. Yeah, I don't have any new, really fresh updates I can give you, but pretty good indication at this point that the structural integrity of the home was damaged so severely that there may not be. It may have to be completely rebuilt. So that's a rough one, but we'll get back to that too.
All right.
And on that, I got to get some running around done. So I will talk to you soon. Thank you so much, Bob.
We'll see you later. Thanks.
See you later. Bye bye.